Hello, I'm Nina Warhurst. Welcome to Mould on the Markets, our regular look at the investment markets with our investment director, Russ Mould.
Hello Nina, how are you?
I'm very well.
Good to see you again. Yeah, very well, thank you.
Very dapper.
Thank you ever so much. Looking very smart, like this burgundy, purple, imperial purple.
Imperial purple, I like
good.
that.
No, it's
Regal.
good.
Okay, what should clients and their advisors be looking at the
Well,
moment?
there's lots going on in the next couple of weeks. We've got the Bank of England's quarterly inflation report on the 11th, the Monetary Policy Committee minutes on the 17th, the Federal Reserve minutes on the 18th, a smattering of economic surveys from the states on sentiment, such as the Empire State and the Philly Fed indices coming up. But actually, I think we need to take a little bit of a step back from the noise and just look at this burning issue of currencies that just isn't going away.
So we don't talk about currencies for ages, and then suddenly
Twice in a row.
Yeah. What's new in the race to debase?
It's very race to debase. Do you charge for that one? Okay, fine. So I think there's a really interesting, it's this issue of divergence that clients and advisors are hearing a lot about right now. Central banks moving in different directions. You've got America talking quite a tough game on rates, at least in theory, that they'll go up this year. Bank of England Governor Mark Carney doing the same. But according to BlackRock, you've actually, the fund management giant, you've actually had 15 central banks cut interest rates or loosen monetary policy this year. Australia, Canada, India, Russia, Peru. I mean, it's a very long list. And so what that's doing is creating a lot of, as we know, confusion in the foreign exchange markets. So currencies are having an increasingly big part to say in terms of some of the individual asset performances. And if you look at this behind me in an equity market context, for example, simple bar chart, and it just shows you who's doing what. And to save your eyes, the bars nearest to me, the winners, are basically Japan and Western Europe, and over on Nina's side, the losers, well, that's very much Latin America and Eastern Europe and emerging markets. So there are two very quick conclusions to draw there. One, the money printers and would-be devaluers, Europe and Japan, asset prices are going up. Two, despite this sloshing around of liquidity, risk appetite isn't necessarily full on right now, because you've actually got the emerging markets down at your side of the chart are actually quite badly underwater, and the would-be tighteners, the UK and the US, are sat somewhere in the middle.
What happens if you take into consideration currency movements, though? Is it a different picture?
Top of the class, very good. Yeah, this is where we're getting to, because if you look at that same chart in dollar terms, the first one was local currencies, this is dollars, and again, it's just capital return, not total returns. There's no dividends included here. The chart does look a bit different. So in dollars, Japan's leadership is much less pronounced. Europe and the UK actually go into loss, and the emerging markets still don't look that pretty, and America inches its way a little bit towards the top end of the table. Now, if you do this in sterling terms, which, let's face it, for the majority of clients is really where the action's going to be and how they'll be measuring their portfolios. Again, the picture's that little bit different. Overseas assets, because of sterling's weakness, actually have been a good place. So in fact, overall, everybody sort of moves vaguely into positive territory, except the emerging markets. So again, risk appetite still seems dampened. Overseas has been a good place to be for sterling holders this year at least. And again, that does just show currency has been very important. And this is all, by the way, since the Federal Reserve stopped adding to QE on the 29th of October, all three charts.
So what can clients do to protect against it, or even, if you like, exploit it, make most of it?
I mean, Mark Carney's predecessor at the Bank of England as Governor Mervyn King once famously said in a speech, only a fool would try and predict currency movements. And I think most clients will rightly shy back from trying to actively second guess where currencies are going. But for those who don't want to have to worry about it, or would just rather sort of hedge against it and then forget about it, put them in a bottom drawer, you can get, for example, exchange-traded funds that will provide hedged vehicles. So you actually get your returns in sterling. Now, for the Japanese market, that's been fantastically powerful because the yen's collapsed, but the ETF has actually been delivering returns in sterling, so giving you an extra kicker there. So that's been quite good news. So that is maybe one angle to consider. The downside to that is they are slightly more expensive in terms of total expense ratio, so you pay a few extra bips for the privilege, but some clients might like that little bit of extra security, even if none of them will probably want to go around second guessing where currencies are actually going to go. One final point just on this currency movement thing, it does apply to other assets beyond equities naturally. The final chart behind us is actually the gold price, interestingly, but in 4 different currencies. Now, gold is up where Nina's sat, 4% in dollar terms. Where I'm sat, nearer this way, it's actually up 12 in sterling, 13 in yen, and 17% in euros. Okay. Now, again, gold is not everybody's cup of tea. Every client won't warm to it, doesn't offer a yield, which is a massive turn-off for lots of people. But for those gold bugs who think that gold is a store of value against currency depreciation and central bank intervention, in some currencies, it might just be doing what it says on the tin right now.
Fantastic, thank you.
Pleasure.
I shan't be predicting currency movements.
I wouldn't
anytime
try it.
soon.
Nor will I hasten to add either.
Many thanks.
Thank you.
That was Russ Mould on the markets.